Well, it's time now for our daily question feature, Need to Know. And this is where you get to ask us anything about money matters. We go to our team of experts and we get an answer for you. This evening's question came via email from Kevin, who wants to know how the Fed meeting taking place in the US impacts on South Africa. ENCA resident economist Trudy Makhaya answered this question.
The Federal Open Market Committee, led by Janet Yellen, is meeting today and tomorrow. This important committee of the American Central Bank essentially will be debating monetary policy to determine when the United States will start normalizing its interest rates. In essence, this means that the US will be raising its interest rates to levels that had prevailed before the financial crisis. This has implications for South Africa because when US interest rates were very low, our interest rates then looked relatively high and attracted investors who are looking for yield. When the US starts normalizing, we will then start seeing outflows from our economy. And of course, we depend on foreign investment for many reasons, including funding our significant trade deficit. Thus, as the US starts contemplating raising its interest rates, we also will have to respond in terms of our interest rates and our other economic policies to ensure that the transition towards normal global interest rates is smooth for our markets too.
Well, as Trudy explained in her Need to Know answer, the Fed meeting taking place today and Wednesday. For a look at the expectations from the meeting, we're crossing now to our correspondent in New York, Nick Harper. Nick, good evening to you. It's an important meeting, this one, for the Fed because they expected to announce the last or final tapering from the third round of quantitative easing. Just how significant is that?
Well, in many ways, yes, this is very significant. It is the end of an era. We've seen almost 6 years of quantitative easing in one form or another. There's been 3 rounds in total of this stimulus program. You have to remember that at its peak, the US government was pumping $85 billion into the economy each month to keep it propped up. That's $85 billion of bonds that it was buying. Many people will wonder, though, whether or not it's worked. It'll probably take some time to discover whether or not the stimulus program has had a positive effect. But if you look back over the last few years, we've certainly seen a turnaround, especially since the We've seen better growth in the jobs market, better growth overall in the economy. It's just really a question now, or whether or not the government has managed to wean the markets off this easy money. They've liked this liquidity. They've liked the fact that the Fed has been buying all of these bonds. So will there be a soft landing if it reduces its stimulus program down to 0 at the end of Wednesday's meeting?
And of course, in recent months, we've seen markets globally trading and rallying at some highs because there's this expectation that the interest rate hiking cycle is going to be coming sooner than what many might have expected from the Fed. What's the word on the street on that one?
Well, yes, the interest rates, that goes hand with the end of this stimulus program, and there has been a worry, especially from the markets who have been jittery over recent months, as to whether this will mean an increase in the interest rate. The stimulus program has kept those interest rates artificially low. On top of that, the government has kept them at near historic 0% lows for some time. So the question is when they will start to increase the interest rates. Originally, the thinking was sometime next year. We thought that it may be early to middle next year. However, there was a particularly bad run on weeks back. The market's all losing a lot. So as a result, we're now thinking that it'll probably come nearer the middle of 2015 when they start to increase interest rates.
Well, the economic data that's been coming out of the United States in recent times has been quite encouraging. Consumer confidence data out today also very, very good. So is the the almighty US consumer quite positive?
Well, yes, we've seen some particularly good data, especially here on Tuesday. We saw this consumer confidence at a 7-year high, highest level since October 2007. Overall, there seems to be a lot more confidence, especially in the fact that the job market seems to have improved. Because if we look back at the beginning of this third round of quantitative easing, the unemployment rate stood at 8.1%. We've seen that drop dramatically. It's now down to 5.9%. So the stimulus has has certainly helped in those terms, and we have seen improvements overall in the economy. If everyone's feeling better, they'll spend more in the shops. And that's important because consumer spending in the US accounts for about 2/3 of the US economy. However, in terms of data, you have to take the good with the bad. As well as this consumer confidence survey today, we've also had figures out on housing data and orders for US, both of which weren't as good as everyone expected.
All right, we'll leave it there. Thanks for your time today, U.S. correspondent Nick Harper. Of course, everyone watching what Janet Yellen and her committee are going to tell us tomorrow. But of course, what is expected is that this will be the last round of that bond buying exercise. $85 billion a month they've been buying of bonds in the United States in this third round of quantitative easing. We still, as Nick said, still need to know and see whether all of this has actually worked out for that economy. Let's take a look now at the markets. And we start in the U.S. The mood there positive throughout the session today. The U.S. consumer confidence numbers we were talking about with Nick rising to 7-year highs, boosting the markets, and Wall Street also buoyed by positive corporate earnings. In Europe, markets are firmer for the first time in 3 days on positive financial updates from medicines maker Novartis and Swiss bank UBS. The good economic data out of the U.S. also adding to the positive sentiment. Here at home, the JSE closed at its highest level in a week, tracking those global markets. Banking shares, the star performers today, with the index gaining 2.25%. Gold stocks were the laggards, though, down 0.5%. On the commodities front, gold prices steady ahead of the Fed's announcement tomorrow. Meanwhile, Brent crude has been trading below the $86 a barrel mark on rising global oil supply concerns and, of course, concerns around the global economic growth. On the currency market, the rand firmer as confidence in emerging market currencies has returned. Meanwhile, global currency market traders watching the U.S. Fed Market Committee meeting. It started its 2-day meeting today. And that's it for today's edition of ENCA Moneyline. Do remember, you can send us your comments, your questions via email, moneyline@enca.com, or tweet us using the handle @ENCA News, hashtagging ENCA Moneyline. Have a great evening. Bye-bye.